even a little bit longer, and I've got a hard cutoff at noon. So I'm gonna go ahead and get started, and then yeah, we'll let people in as they come. So all right, get the slideshow started. All right, hopefully you guys are here for the Central Ohio March real estate update. If you're not, feel free to stay anyways. For those of you that may not know me, I have been an agent since 2004. I run a team here in Columbus. We recently expanded out to northern Colorado Springs, southern Denver, obviously in the state of Colorado. I am a real estate investor, so I own quite a few properties myself. I also have a property management company, and then I do a little bit of coaching as well. So that's kind of who I am. Feel free to follow me and our team on social media. All right, so I apologize. This did not get updated, so I'm just going to move on. I want to put a disclaimer into these numbers. So as most of you who already know me know, I love numbers. And yet at the end of the day, you can have all the numbers in the world, but if you don't know how to talk to your clients about what they actually mean, they're largely useless. So my encouragement to you is to, obviously take all of this information and, digest it and be able to talk about it. But I think if you're not a numbers person, the easiest way to do this is to pick one or two things that you feel like you can talk about intelligently and just really understand that and really crush that when it comes to talking to buyers and sellers. And if you just know a little bit of something more than your clients, which all of you know a lot more than your clients about real estate, even if you're a new agent, you know a lot more than 95% of the general public. Take those pieces of information, and by just knowing something that they had no idea about, it will definitely put you in a position of authority, and it will win you clients. So just make sure that you just don't like blurt out a bunch of numbers and give no context, because the average person just doesn't understand that. So all right, interest rates. I would say interest rates as we go through today, just like it has been for the last 2 years, the general theme is interest rates are driving the market for sure. So we saw a pretty big drop in rates towards the middle to end of February, and then they've really kind of been sideways ever since. And so, I'm not anticipating, I never was, and I think most experts were kind of saying the same thing. I don't think there's really many people out there right now who are expecting rates to drop a significant amount in 2025. We're definitely in an improved state compared to where we were for the last quarter of 2024. And I'm hoping that they come down more into the middle to low sixes on a national average, which should put us here locally closer to the upper fives. But obviously, there's a lot going on from an economical perspective right now. There's a lot of uncertainty, given the new administration, and how quickly some of these changes that they're trying to make happen, I think will drive interest rates one way or the other. And obviously the tariff conversation is a big conversation, which actually that has honestly led to a little bit lower interest rates because the stock market has come down with concerns around tariffs. So in general, though, when the stock market is going down, interest rates go down. When the stock market is going up, it tends to put upward pressure on interest rates, and there's all kinds of reasons why. But I always tell my clients, if you're looking for an easy way to follow rates, for the most part, if you see on the news at night that the stock market went up today, interest rates probably stayed flat or went up. If you see that the market went down, there's a pretty good chance, especially if it was significant, that interest rates went down as well. So for you guys who don't follow it very closely, that's an easy way. Another way for sure, as an agent, I would encourage you guys to go to mortgagenewsdaily.com and sign up, download the app, and just sign up for the push notifications. They send out like 1 or 2 a day. And it really, don't pay too much attention to this number, but do pay attention to the direction that it's moving, because that's going to be significant. It'll help you have better conversations with your clients. All right. I actually don't really use Equitable Mortgage, to be honest, but I think they send me a really clean rate sheet that is pretty easy to share. I would say that their 30-year fixed, there's been some ups and downs over the last couple weeks, but just like our last chart showed, I think most lenders are somewhere locally in that like 6.375, give or take an eighth of a point either way. So again, just like I always point out, typically our local lenders on at least their top tier borrower, so somebody with a 740 to 760 plus score, going conventional, they're going to be pricing about 0.5%, maybe a little bit less than 0.5% less than what you see on Mortgage News Daily. That's like an easy way to like kind of gauge where local lenders are. And then I see the most variation locally in the FHA arena. Some lenders like get down to as much as like 3/4 of a point to sometimes even a whole percent lower on FHA versus conventional. FHA and VA, I should say, versus conventional. But you can see here, this one is around 0.5 point difference. That also depends on whether or not they're charging an origination fee, which I don't think these guys are. So if they are charging an origination fee, it might be lower. But long story short, interest rates are way better than they were 3 months ago. So that's a good thing. Does anybody else, before we move on to the next topic, does anybody else have anything to add or questions around interest rates? Because I feel like as we get into the data, interest rates definitely drive the conversation in a pretty big way.
Yes, Troy, I have a question for you.
Yeah.
So it's so funny because looking back, I mean, you would know way more than I would because you're the numbers guru, but it's very interesting being in different crowds of realtors and so-called professionals who say that interest rates are really high right now. Some will say it's average, and some will even say it's a little bit lower. In your opinion, looking back at the last 30 years, how would you feel saying where the interest rates are?
Yeah, that's a really good question. And I think everybody that you're talking to is correct.
Okay.
And really what the difference is the time period that they're looking at, right? So if I went back and showed the interest rates over the last 50 years since 1978, which is really when they started kind of tracking it, you would see that from a historical perspective, in the 80s, interest rates were in the teens, at one point as high as like 18% for a 30-year fixed mortgage. So if you compare that to a 6.75% mortgage, certainly that sounds amazing. The problem is if you were buying a house in 1980, let's just say you were a go-getter and you were buying a house and you were 20 years old, you're now 70. Most 70-year-olds aren't buying houses, and most of them that are paying cash. So to say that like we should all be excited about a 6.75% interest rate because 50 years ago rates were 18% is a little bit of a stretch. And so that's where I say, like, technically, if you're a 65-year-old agent, no judgment, but like the average buyer in today's market did not buy a house ever at 18% interest. So then you start going into, okay, where has it been historically? Well, And I'll actually put this together for next month so you guys have some data. And if you really need it in between, email me because it's pretty easy for me to throw in an email. But you know, in the 90s, we were right around where we are right now, like between 6 and 8, 9% for most of the 90s. And then it was in the early 2000s when rates started dropping down into the fives. And then fours started around 2008 when everything crashed. And then in last decade, um, they just kept going down. And a lot of that had to do with the fact that the housing market was in the tank. And so the government was artificially lowering interest rates in order to spur activity in the housing market. And then so in 2018, they started raising the short-term rates, which puts pressure on the long-term rates. And so rates actually had gone up over 5% for the first time in 10 years right before COVID. And then when COVID happened, um, the government was trying to stimulate the economy again. And so they artificially lowered rates. And if you guys are interested, maybe sometime we can deep dive into this topic. But there's a several levers that the Federal Reserve can use to lower mortgage rates, and they did it. And they did it, in my opinion, for too long. And so that made housing super affordable, even though prices were rising just because of the interest rates. And now we're in a situation where they're actually still doing the opposite, actually. The Federal Reserve is actively pushing rates up with their policy currently, mortgage rates in particular, because they're selling mortgage-backed securities that they own, and that artificially puts upward pressure on the mortgage rates because it's flooding the market with mortgage-backed securities. And so all of that being said, I think everything is relative when it comes to interest rates. And if you're a 25-year-old, 5 years ago was COVID. And ever since for the first 3 years that you started paying attention to mortgage rates as an adult, you only knew rates at 2.75. So the perspective of a 25-year-old, and maybe they didn't even start paying attention then, half of their adult life has been 2.75% interest rates, and then half of their life has been 8% interest rates. So for that person, like what's high and what's low? Well, we're really high right now compared to their version of reality. And I think most buyers fall into that category where they still remember 3% interest rates and therefore 6.75 is still high. Now, what I will say is the American consumer's brain, typically it only goes back about a year. And so that's why you see a lot of first time buyers who are willing to enter the market right now. But now we have an affordability problem because interest rates are high and prices have not gone back in order to put affordability into a normal range. So our mortgage prices, our monthly mortgage payments compared to our income is still way off, from a historical perspective. And actually, I'm going to write that down because I'm going to try to see if I can find some graphs that show that, and I'll have that for next month. Um, because we are way off in terms of
Yeah.
housing affordability. And that's why, for any of you that own investment properties, buying investment properties is super hard right now because um, the the lack of affordability due to interest rates makes housing the mortgage payment, if you're not paying cash, really high. But yet rents have not caught up. Rents have not increased nearly as much as mortgage payments have over the last 5 years. And so if you own rental properties, you're feeling that between the increase in insurance, the increase in property values, which 2 years ago led to a huge increase in property taxes. And so those escrow payments I mean, I had rental properties that I'm just now finally getting back to normal escrow that like last year to get me caught up on the increase in property taxes and the increase in insurance last that happened 2 years ago. My catch up per month was $700 to get my escrow account back where it needed to be because the property taxes went up so much and insurance went up in the same time period. And so when you look at that from an investor perspective, it's put a lot of stress on rental properties. But I do think the good news is that that's going to be changing because I think rents are going to continue inching up to try to catch up because economics likes equilibrium. We're never in equilibrium, but we're always moving closer to it one direction or another. So thanks for the question. Did that answer it, or did I just go off on a long tangent and not really answer your question?
No, you did answer it. You did kind of go off on a tangent, but another great question that was brought up by Jay and by you talking is why are people still holding on to pre-COVID rates and expecting a drop? And how do you deal with that when people uh, say that?
Yeah. Well, that's a great question. I think the answer is somewhat obvious, but we don't like it. And that is that they have a fixed payment that's way lower. So wages have gone up over the last 5 years, actually more than they had been for a long time. But unfortunately, they haven't gone up as much as mortgage payments have. So I think part of it is back to that affordability conversation. And then the other part of it has to do with the fact that people have that 3%. So when we talked about what the first time buyer's reality is, they have to think back 3 years to remember a time when it was 2.75. But the person that owns a house right now gets reminded of 2.75 every time they open their mortgage statement each month. And so to convince people to do that for no reason is challenging. Now, the reality of it is though, is the further away from 3% mortgages we get and the more wages increase and people get promotions in life, right? Like as you move up the ladder, for lack of a better term, in your life, you typically start to make more money. And so that difference in payment just becomes something that you get okay with in order to have the house that you want. And so what like I said, what my opinion is, we're gonna continue to see affordability come back into equilibrium, but it's mostly gonna be driven eventually by increased wages, eventually by increased rents. That's gonna bring that affordability. And then I think in a smaller part, but it will be significant just because anything helps. I think we will see interest rates come down closer to 6%, and maybe even into the mid to upper fives over the next couple years. But how quickly that happens and when it happens is definitely not guaranteed. So I'll do a deep dive into that. That's a fun topic. Honestly, I've been kind of looking for something fun to do. So I'm going to work on that over the next 3 weeks and I'll have that ready for you guys for next month to kind of do a deep dive into that. So I guess we'll see how interested all of you are, depending on how many people show up, knowing that that's what we're going to talk about. All right, so let's move away from interest rates and into kind of what's also bolstering prices, meaning why aren't prices dropping? And this chart, I think, puts it into perspective really well. So this shows multifamily and single family construction over the last 10 years or 11 years. And what you see is that during COVID, we had a significant bump in construction, both in single family and then also in multifamily. And we are now coming back into equilibrium for both of those. Why is that important? Because we still are, especially in central Ohio, we're extremely underbuilt. So I heard a stat recently that in Indianapolis, which is a similar size city, they um, built about 19,000 homes in 2024. Does anybody know how many homes we built in central Ohio? No, no one knows. Okay. It was 11,000. So about, I don't know what that math is off the top of my head, somewhere around 55 or 60%. So we were about 40 to 45% fewer homes built. Also, Indianapolis, same size city, similar area, right? The average new construction home in Indianapolis is over $100,000 less than the average new construction home in Columbus. So from an affordability perspective, number one, we're underbuilt. So that pushes up the prices of resale homes because there's just as much or more demand, but there's not as much supply. And then on the new construction side, we're also pushing prices up because you can't get new construction for less than, I mean, I think the average in Columbus right now for a new home is over 500,000. And so it's, there's no new construction market in the 400s. And so therefore they're stuck with the resale market. And that's why Daniel, you and I both saw for $400,000 properties, 50 showings this weekend. And we only took two of those buyers off the market by going into contract, right? So it's going to continue to be a problem. And what we're seeing is because of the slower economy, the average home builder is scared to build too many houses. So they've actually taken their foot off the gas as interest rates have stayed high and quit building. This here, not to go far too down the investor road, because I know most people don't deal with investors every day. But if you look at the multifamily construction from during COVID, multifamily was like the sexy investment, even for people that didn't even normally invest in real estate, because people were getting together and doing syndications where you pool a bunch of people's money together to go build or rehab multifamily properties. That dropped off basically immediately in 2022 when rates went up. But multifamily construction usually takes 2 to 3 years to get completed. And so there's been a backlog of multifamily construction. That backlog is getting worked through, and as you can see, they're trending downward. They're down for sure year over year, and it's going to trend back to what would be a normal growth pattern. And I think that has kept rents lower because those big multifamily buildings, they have to get them rented almost at whatever price. So they give a ton of incentives for people to rent. And as soon as those buildings get full and they quit giving those incentives to everybody new, I think you're going to see a little bit more growth in rent prices. But I think especially in the downtown area, the rent prices have been kept artificially low by so many new multifamily units coming on the market. But as we see the multifamily units not coming on the market, I think we'll continue to see some growth in rent prices. All right, quick blurb about foreclosures. Long story short, all those people on YouTube that said that foreclosures were going to explode, you need to just screenshot this and just put it in every comment for every video that you see. And basically that is that since 2003, we are basically remain at the lowest levels of foreclosures in the last 25 years. So we're in no danger based on the data of single family, 1 to 4 family residential homes going into a major foreclosure crisis. All right, here we go. We're going to run through numbers because I spent a lot of time talking about stuff that I didn't really have slides for. So um, Active listing count, we're up about nationally. So remember, these are from realtor.com national numbers, 27.5% above last year. You can see we're still below 2017, 18, 19, and 20. So, but we're inching closer and we're definitely above all of the pandemic years. Total listing count. So this is the amount of inventory on the market, basically same conversation. So up 18% year over year. But we still have not quite caught back up to pre-pandemic levels. But I think, we're again inching slowly back towards what would be considered a normal market. Because the line was kind of blurred in here, I decided to circle it. Pending listing count, pretty much in line with where we've been the last 3 years in February. So that's always interesting when inventory is rising, but pendings are staying the same. That typically means we'll continue with inventory growth. Days on market is up a little bit over last year for sure. I wouldn't consider 5 days out of 66 days to be super significant statistically, but certainly things are sitting on the market a little bit longer, which we'll see in the price reduced slide here in a couple slides. It bears out in that data. Median list price is kind of right in line. It's off a little bit compared to last year on a national basis, but once we jump into Central Ohio, we'll see we're still up year over year. So I think most experts are still predicting pricing to be pretty flat this year. It could be up a couple percent, could be down a couple percent. And I think a lot of that will be driven by interest rates. If we see interest rates remain at or below where they're at right now, I would expect it to be up a little bit compared to last year by the time we get to the end of the year. If we see interest rates go up, then we might see a little bit of a decline in pricing, but I just don't think we have enough inventory to see a significant decline. I think the only thing that could cause a significant decline in pricing would probably be a decent recession, meaning that we saw a significant number of people losing their jobs. And I think that's going to be very area specific if we were to see that, but we'll keep an eye on that. Here's price reduced share. This is kind of the holy crap data point. And that is we're up about 17% year over year in terms of the number of price reductions. I'm sorry, that doesn't seem right. We're up 2.2%, but it's a 17% increase over last year. But it's by pretty significant margin the highest number of properties that received a price reduction in February compared to going back all the way back to 2017. So I think some of that is seller expectations are a lot higher. And so when they don't get an offer immediately, they're quicker to reduce the price than we used to be. But some of that too is softness in the market for sure. All right, median list price year over year compared to different regions. So the Midwest has seen a slight reduction, which is interesting. The Northeast is even, but then the South and West have actually seen prices falling backwards. So this will be interesting to keep our eye on. You can see if we go over here to median days on market in the Midwest, we've seen the biggest increase, even higher than the South and the West. But again, it hasn't really correlated in a change in list price. So we'll continue to keep an eye on that. But the Northeast has continued to be the stronger market out of the four. And I think that's largely just because inventory there has stayed lower. It's not necessarily any other reason other than just more people hanging on to that old mortgage rate. All right, what's happening in Central Ohio? So if we look at the entire market for the month of February, inventory was up 42%, which is definitely significant. New listings, however, were down 5.6%. Why do I believe that happened? I think it was all due to the fact that rates rose in the fourth quarter. And we had sellers that we were expecting to go on the market that sat on the sidelines. So the number of new listings was down. has been down for several months in a row, and that led to fewer sales. Um, as you'll see when we will start looking at March, though, remember rates started dropping in late February. And so what we saw is that some of the inventory started to get gobbled up at the end of February and definitely going into March. And you guys feel free to interrupt me if you have questions. I'm kind of flying through this because we spent that extra time earlier, but I don't want to fly past it so fast that uh, we don't get to questions if you guys have them. So again, I would like to break out new construction and resale. I mean, in the MLS, the new construction is relatively insignificant in terms of the number of properties. As you can see, there were 2,821 new list or active properties for sale in February, and then that were resale, and only 539 that were new construction. But you can see that the number for sale actually went down from January to February. And I think that was totally due to the fact that rates started dropping at the end of February. But new listings being less in February than in January is like almost unheard of. So that was, listings. Typically, sellers don't call you and tell you that they want to list their house tomorrow, whereas buyers can call you and say, I want to go look at this house tomorrow and go into contract. So the listings tend to be like a lagging impact, whereas buyers tend to be able to make a quick impact. And that's why this time of year, we see more buyers in the market than new listings. Because once the weather turns, everybody starts thinking about moving, but the sellers take a little bit longer to get going. Again, I like to look at January to February to look at those trends. Typically, in a normal year, these numbers for sale as well as the new listings are going up. But I think, again, due to interest rates, they went down. These are month-to-date numbers in March. And again, this kind of bears that same conclusion. And that is that, at the end of February, sellers are like, oh, let's go start getting on the market. And so actually month to date, we are ahead of last year over the same time period. And I would expect for us to lengthen or to increase that lead over last year in the month of March, given the fact that these numbers were pulled yesterday, which went through, or today. Actually, I pulled these today. So it went through yesterday. And so obviously, as you guys know, usually a lot more properties come on the market Wednesday, Thursday, Friday. So if we're already ahead, I would expect we'll continue to pull further ahead. But then you see that the sales are still down year over year. And that's largely due to the fact that January and February were a little bit slower in terms of active or new listings. Here's some good news for you guys too. We had been seeing a pretty steady decline since May of last year in terms of the sales price to original list price. Again, my guess is that that's due to both spring demand starting as well as lowering interest rates. But we were all the way down to 95% of the original list price for the average sales price. And now in February, we popped back up to 97, which is the first time we've been at that number since October of last year. So and then we also saw a slight decrease in days on market, which again was the first time that we had seen a decrease since May of last year. So again, pretty typical. If you look at last year, pretty typical that in the spring days on market drops, but definitely good news that we're not headed all in the wrong directions. Months of inventory. Remember that the average rule of thumb in real estate is 4 to 6 months of inventory equals a balanced market. We still remain pretty strongly in a seller's market, meaning that if you price a property correctly for its location and condition, you should expect it to sell pretty quickly. So 1.7 months of inventory means that if no new listings came on the market in 1.7 months, assuming the same buyer activity as last month, in 1.7 months, we would run out of houses to sell. Obviously, that's not going to be factual, but in theory, that's what this number means. And obviously, we apply the data the same way every month. So it provides a consistent kind of snapshot as to where we're at in the market. So it'll be interesting to see as we go into March, April, May, if with the lower rates, buyer activity increases and continues to push this number down. So we'll see what that looks like. All right, if we have to still go all the way back to 2019 or 18 to see inventory, the months of supply to be this high. So just keeping that in mind that we're still very low compared to like what would be considered a balanced market, but we've been way lower for a lot longer. So I know some of us are feeling that with some listings sitting on the market a little longer than in the past. All right, some more good news. Pricing. We had been on a steady decline, which is very normal for usually pricing peaks in that May-June timeframe and continues to go down. It's just how far down does it go? And you can see that we bumped up fairly significantly in February. We didn't bump up nearly this much from January to February last year. So if that trend continues, I think in Central Ohio, we probably will see a little bit more price growth than we see in the nation as a whole. And that's largely due to our just extremely low inventory, as well as continuing to not build enough houses. But in February, our sold prices were up 5.3% year over year. Active prices continued to be down. I still think when we're talking about average pricing, the numbers are off a little bit due to some of the impact from like that Intel area where you were having listings coming on the market at crazy number of millions that weren't really realistic and they were just sitting on the market. And I think as the market cooled down last year, we saw some of those get taken off the market. And so now the average list price, I expect to stay more in line with what the average sales price is doing, which had been a little bit off of historical norms in the past. All right, this is an interesting one that I've and I don't know. We'll see. We'll see what happens with this. I started tracking this thinking I would see this like great correlation between interest rates and showings. This tries to prove my point, but remember we're also so the showings are the yellow line, the gray line are the interest rates. You could look at this and say interest rates have been going down, showings have been going up, which I do think has an impact. But the other thing that has an impact is the fact that it's springtime and showings always go up in the spring. And what you'll see on the next slide is that even though last year interest rates were going up during this time, we still had a similar number of showings. So I'm not sure of the statistical significance of this, but it is very interesting to see this like distinct correlation between rates come down, showings go up. So we'll continue to keep an eye on that. This one is my favorite one, as you guys know. Allison and Marlene on our team put the work in to build this. So you can't get this anywhere else, at least to my knowledge, unless you build it yourself. So this shows the showings over the last 4 years per week in our market. And basically we are 2025 right here. We're kind of right in the thick of things, right where we kind of were last year and the year before. Obviously in 2022, interest rates were still low. They were starting to rise around this time. So we're still well below the activity levels of like the COVID era. But we're pretty close in line from a demand perspective, which is, I think, what the number of showings per week kind of reflects is how much buyer demand is in the market. We're right in line with where we have been the last couple of years. Remember, do not list your house on Easter weekend. So let everyone else do that, but buyer demand tanks on Easter weekend. Now, one thing that will be super interesting, and I can never remember how we figure out what weekend Easter is. I know it changes every year, but this year, other than I found out yesterday that the city of Columbus spring break is still the week after Easter. Um, but I know most, if not all, of the other suburban schools have spring break sometime either last week, this week, or next week. And so it'll be interesting to see if showings drop as much this year around Easter because there are few spring breaks associated with it, or if they still drop. But you can see that over the last 3 years, Easter weekend, the demand has literally been equivalent to the week of 4th of July, which is pretty low. And actually, was this green? No, that was 2023. In 2023, Easter weekend demand was lower than the 4th of July. So extremely interesting, but just don't put your listing on the market the week of Easter. Or the weekend of Easter. That is my recommendation to you based on this data. So again, pick one thing. So screenshot this, take it into your listing appointment, and tell your seller if you're not ready by the weekend before Easter, you need to list it the weekend after Easter, but we're not putting it on the market the weekend of Easter. And here's why. It's very clear. So one last thing, rents. We talked a lot about rents with no slides, but rents are starting to pick up. I'm seeing this in my own business. On the property management side of things, there's a lot more demand here in the last 30 days than there has been for the last 4 or 5 months. And you can see, according to Zillow, that the average rent this year so far has stayed above last year. So I think we're going to continue to see rents increase. It'll be interesting to see by how much. And then again, if you're working with investors, here's another just cool thing you can talk about. You can see that the sweet spot in Columbus, Ohio is between 900 and about 1600. Once you start going above 1600, you start getting into areas of less and less buyer or renter demand, which means that your property probably is going to take longer to rent, and there's going to be higher expectations from the renters themselves. So those are the things. And again, this is just data that you can kind of use if you have an investor or a renter. Well, probably most of you aren't working with renters, but with an investor. All right. What's everybody got? Anybody have questions, comments? I kind of flew through that data portion, but anybody have anything?
Hey, Troy, Chris here.
Yeah.
Just a quick thing, I guess, great data. I think it really helps agents support, information for their buyers. One thing I would also say, I guess, with looking at the local market, I know you're just looking at the whole MLS, and I do that as well. But we have listings spread out all over, and so I think everyone, when you're looking at that trend graphic stuff, you can drill down even more, like per zip, when needed, because obviously you want to be speaking to that person in that area. So for instance, Worthington, I drilled down into that, and there's very few listings. They sell really fast. So if we're talking to sellers, we don't want to use like all of Columbus data. We want to get even more hyper local, depending on what neighborhood you're in, because at least our listings, we're seeing some sit, but then of course others in hot school areas are flying off the market still. So definitely want to always drill down even more, per zip, per neighborhood, etc.
Yeah, that's a great point. And and Chris, I know you actually are the one that introduced me, I think, to Altos.
Yeah.
Way back several years ago. And one of the things he does, and maybe I'll start doing that, is just pulling a couple random local areas just to show that variation. That might be a good addition to our data every month. I know they do that once a month, kind of drill into a couple specific markets just to show that variation. But I know I don't think you were on here at the beginning, but Daniel and I were talking about, having a couple listings over the weekend in that 400 price range in Dublin and Hilliard getting 50 showings. So I definitely think that each market is different. I don't know that we have enough data yet, but I would not be surprised to see some stuff in the Pataskala, Johnstown, New Albany area soften a little bit more than it has due to some concerns or questions around the Intel stuff. That's only a prediction, but obviously, I think people that were speculating in that area are certainly going to go on hold. Maybe most of that's already worked itself through the system anyways. But yeah, I think there's definitely going to be some impacts, and I think we'll probably see Southeast Columbus with Andrill doing that big project at Rickenbacker. I would anticipate seeing especially stuff in like the 2 to 400 range get really competitive. Just because there are so many jobs that are going to be coming to that area. So I think definitely you're exactly right that there's a lot of local variation and reasons for that. And so I think that actually might be a good thing to dive into, pick an area or two every month. So I appreciate that feedback, and always a good reminder. And I guess that's another good reminder too, for all of you who are with consultants, you do have access to trend graphics. And if you're not using that as part of your listing presentation, you're absolutely missing the boat. Again, you don't have to know every number, but if you can go in with information that the average consumer doesn't have into a listing appointment, especially if it's competitive, first of all, it's going to make you look better because you're actually going to be able to advise people using real data instead of emotion and your experience, which is always, if you just sold a listing in Dublin, it doesn't necessarily mean that one in Newark is going to sell the same way. But also it's just going to make you look so much more professional, because I can tell you no more than 20% of agents are using anything other than pulling a few comps. And I've heard so many stories of agents coming into listing appointments and not even having comps with them. So have some data to back up your opinion. The consumer expects it, and it puts you at the front of the line pretty quickly. Chris, did you have anything else to add? I just totally hijacked your comment.
No, that was great. I think Altos, you brought it up. I know you use it. I use it. Altos is great for drilling down into zip codes. And what I like is it's like real-time data. So where we're waiting kind of 2 weeks to a month on trend graphics to catch up, sometimes I like pulling that real time to see where that, where the graph is trending, I guess, on Altos.
Yeah, that's good. And I go further with that too. And I'm sure a lot of you probably do this too. But I mean, when I'm going on a listing appointment, I'm pulling up the whole neighborhood and I'm looking at how many are active, how many are in contract. And like last night I was on a listing appointment and there were 4 places in contract in the neighborhood, and one of them had been on the market for 83 days, and one of them had been on the market for 44 days. And then the other 2 had gone into contract in less than 5. And so what that tells me, I went back and confirmed this, but in the last 3 weeks, those 2 properties that had been on the market for 1.5 months and almost 3 months all went into contract. And then also the new listings that were put on the market went into contract immediately. And so that tells you that the market has shifted, because those 2 properties had been sitting with no offers for 1.5 to 3 months. And then now they, as well as all the new listings, went into contract. So that shows that demand is significant. And now a neighborhood that sold like 30 some properties last year only has one active listing. That's a really, really low months of inventory, like so low that way below 1 month. So, you know, if you look at the number of in contracts at 4, and if you have one active property, that means you have a week of inventory based on the current demand in that neighborhood. So I agree with you, Chris. Yeah. Going to trend graphics. I use trend graphics mostly to talk about trends and when to list. And like I've told you guys in this setting, and then also at the office meeting over the last couple of months, between now and the middle and the beginning of May, maybe the middle of May, is historically the best time to be a seller. Because by the time you get to sometime in May in most areas, the buyer demand starts to drop off. The demand is there, but they're eating up those new listings. And typically your number of pendings starts decreasing in June and continues a downward trend with a one blip usually either in August or September. And then continues a downward trend all the way until next January. So if you have a listing and the seller's dragging their feet, sending the chart of their area to Chris's point, you know, looking at Dublin schools on trend graphics, what's happened over the last 15 months. You don't want to wait until May or June when the highest number of new listings are coming on the market to put your house on the market, because you've already missed the best time of the year from a demand perspective if you wait until June. And certainly if you wait until July. July is a rough month to list compared to the month or two before that. So again, you look like a hero. And at this time of year, you can move some clients up in the process. Now, if you're a buyer, nobody wants to hear this, but if you're a buyer, you've already missed the good time of year to buy. And so really July starts more pro buyer time period again. So if you have a buyer only, you need to be preparing them to compete at a much higher level than they were certainly a month ago and definitely 2 months ago. So there'll be more to choose from, but like we talked about earlier, 50 showings on one listing, that was not happening 2 months ago. So cool. Anybody else have anything? I've got about 2 minutes. No? Are you guys sure?
Thank you so much, Troy. We appreciate you greatly.
Yeah, you're welcome. And I will be here if any of you guys, I'd love to see all of you. I am here in Columbus this week, so I will be here. Was I here last month for the office meeting too? I think I was. So I'll see you guys in person if you guys can make it into the office meeting for those of you that are at consultants. So I appreciate you guys coming and your support. I enjoy doing this, so it holds me accountable too to getting the research done. So you guys have a great week, and I'll hopefully see most of you on Thursday.
Thanks, Troy.
Thanks.